Okay, so let's make a full breakdown of the situation that we currently have on Euro USD. Now, starting from the monthly time frame, we have a market that clearly has rejected multiple times the previous low. In fact, from here, the market had started this move to the upside, creating a demand area. And then again, the market went to test this zone multiple times with many monthly candles that each and every one of them rejected the zone to the upside and closed above the area. And then the market started this nice impulse to the upside very, very aggressively. Now, if you're asking yourself why the market started this huge move to the upside, it's because clearly institutions added a lot of longs on Euro USD. In fact, if we open our COT data, which is the commitment of traders, which is what the biggest banks and institutions are currently doing in the market, so the non commercials, which are the biggest speculators, we can see that they have shifted their positioning massively from having minus 114k net positions, so way more shorts than longs, with 271k shorts and 157k longs, to a situation where they now have way more longs than shorts, with at the moment 259k longs and 62k shorts. So clearly institutions have been longing Euro USD very, very aggressively. And if you check the data for the euro, you are already checking Euro USD. Why? Because all currencies on the spot are traded against the USD. So when you check the data for the euro, you're actually already checking Euro USD. And in fact, clearly we also wanted to see this continuation to the upside. In fact, when the market was here, we first spoke about the fact that we wanted to see a retracement exactly to this zone. And then we spoke about Euro USD again, explaining why exactly we wanted to see this continuation to the upside. And I will link all the reasons with the detailed analysis in the description so you can go and check them out for further reference and more free education. So you find all the previous analysis linked in the description. I suggest you go and check them out. Now, here in the weekly, the situation that we currently have is a market that clearly is overextended to the upside, and we would like to see a retracement. We can also see that the market has now created this first retracement candle, from which we expect another bearish candle to follow. Specifically, if we want informations on this possible retracement, what we have to do is take our Fibonacci from the low to the high of the impulse. And we can notice that we will have a first possible target to the downside at the 0.32 of the Fibonacci taken on this weekly impulse. Going down on the daily, what we can see. Now, on the daily time frame, we can see that the market has just created a quite strong structure area. In fact, in creating this move to the downside, the market created one candle which is not related to the move, which is exactly this green candle, showing that the market at this level has actually shown a reaction to it, creating a zone of previous support which is now turned resistance. Now, first of all, if the market will continue to the downside from here, what kind of pattern will the market have created? Let's say, for example, that from here the market just continues to the downside and reaches this zone without going for the test of this area. At that point, if the market creates a move to the downside, we will have an M formation. And after an M formation, what do we expect? We expect the market to complete the pattern at the neckline, aka in this case the previous support turn resistance, which is exactly the supply area that we have just identified. So if from here the market will just create a move to the downside, then what we will be doing with students, we will be monitoring price action on the 4-hour time frame, all inside of this area. Why? Because as usual, monthly, weekly, and daily combined with the COT data are the best time frames for the direction of the market, but the best time frame for entry is the 4 hours. So if the market will make a move to the downside, during this move to the downside, we will be waiting on the 4-hour time frame for the market to shift from a bearish market to a bullish market. And as soon as the market will shift from a bearish to a bullish market, we will be taking a nice long for a good risk to reward and good probabilities for the market to make the move to the upside to complete this M formation at the neckline. And then from this area, what we will be doing from this area, again, we will be monitoring price action on the 4-hour time frame, waiting for the market to provide to us one of our valid entries for the continuation to the downside and the creation of this impulse, correction, and impulse pattern to the downside. It's only a matter of understanding, will the market first go a little bit lower before starting the retracement, or will the market immediately go for a test of the area. Now, as usual, trading is reactive and not predictive, so we simply have to wait for the market to actually show us what it wants to do, and then with students, we will be ready to react to what the market will show us according our rules. Now, if you enjoyed this free analysis and education, make sure you drop a like and a comment. It really does support the creation of more free education and analysis for all of you, and I will see you in the next video.